Hello and welcome to another video on Liquidity, our banking simulation title in development. So in this video, we're going to talk about the idea of liquidity itself and sort of where the name of the game comes from and how it plays a major role in gameplay and is sort of one of the things you have to really think about as a failure mechanism. So we have this sort of little collapsed window here, which is our bank summary window. We can double click on it to extend it out, and it has some more information here about our finances. Or if we lose it, we can always go back to our program window and then click on the bank summary here to load it up. Anyway, so we'll have a quick talk about these different components here. We've got cash, which is essentially just the money on hand. And then we have our assets, which includes our cash, but also other things. So we saw in the first video that if we made a loan, that is considered an asset, right? So if we make a loan and the value of that loan is perceived to be higher than the cash we lent it for, we've immediately made money. And then we have liabilities. So these are sort of things that we owe. And essentially, equity is the difference between your assets and your liabilities. So that's why it's a really good way of sort of encapsulating the overall health of the bank. So this is sort of our headline number, and this is what we generally strive to make as high as possible throughout the game. But it's very important also to be aware of these other numbers as well. And that's sort of what this video is about, to make sure that we keep on track of those, because, you know, for example, we could end up lending out, we can't lend out more money than we have cash. And it's not only a question of not having it available to us, there are certain rules and restrictions in place. This game is set in the mid-1990s, and that's intentional. So it's before the financial crisis, and it's before some of the rules became much more strict. So we sort of want the banking experience to be a bit more like the Wild West after the sort of the big bang of the 1980s and before the financial crisis. So that's sort of intentional. Okay, so let's just run through an example and see what happens, how we can get ourselves into trouble. So the first thing we'll do is we'll do the same thing we did before. We'll load up, get a product manager, and we'll make a new financial product. So make a personal loan. And as before, we need to set the interest rate. So the way the game is designed is that every time you start the game, on sandbox mode at least, the central bank rate will be different. So if we go to our internet browser and go to personal loans, you'll see the central bank rate in this case is 10.25%, which is quite high. And there will be certain aspects of gameplay which feel very different depending on what the central bank rate is. That's essentially all other interest rates are derived from that. Sometimes directly, sometimes indirectly. But if we live in a world, as we are in this playthrough, of a high interest rate world, well, that means that the personal loan rates are going to be high. So what have we got here? We've got a range from about 12.5% up to 18.5%. So remember, we're lending money, so the interest is paid for by the customer. So therefore, if we want these products to be attractive, we need to make the interest rate lower than our competitors. So basically, they don't have to pay as much interest. So we could do something like set the interest rate to say 12%. So let's do that. We can just type it. And I'll do, it doesn't really matter at the moment, but we'll do daily installments. So lump sum at maturity means you don't see any of the money until the end. And daily installments is you get a payment every day. The sort of standard at the early game is daily installments. Once we start looking at things like collateralized debt obligations, which is where you can package up lots of different personal loan products or mortgages and so on and sell them, then you want to have the other type of repayment system typically. Anyway, so for us, we've got 12%. So let's set that up. We've got a 12% personal loan. And then let's also look at deposit accounts as well. So in this case, the interest rates are still quite high, but they're obviously lower than the personal loan because we need to be able to make money. So as a reminder, deposit account, the customer places money with the bank, just like a normal checking account or a current account if in the UK, and they'll be paid interest on it. It's probably quite an unfamiliar thing to a lot of people nowadays since the financial crisis, where rates in a lot of developed countries are very low. But before the financial crisis, you used to be able to put money into banks and get a non-negligible amount of interest on it. So this is the sort of the world we're living in. So here, these are the sort of rates. So it's a little bit of a tighter spread here. We're going from, say, 8 to 10%. So I think if we make a current account or a deposit account around 10%, then that should be pretty competitive. People would like to deposit their money with us. So let's do that. Let's create a deposit account, and we're going to set the interest rate at 10%. Everything else we'll just leave it as it is. Okay, so we've got our product set up. We've only got a 2% differential here, so we got to be very careful and make sure we don't make any bad loans, because we could quickly lose all of our profit if we do that. But let's run time forward and see what happens. So currently we can only go at 1,000 times speed, but I'm going to cheat and allow us to go faster than that for the purposes of this video. So I'm just going to the qualifications tab and unlocking the 10,000 times game speed, which allows me to go up 2 more steps. So we got our first customer, triple C minus. I don't think that's a very good loan, so we're going to reject that one. But let's keep going. BBB plus, that's much better. Let's approve this one. Incidentally, we can look at the different ratings in what we call the bank manual. So this is sort of like the encyclopedia. We'll probably have another video just on this, but it's quite an extensive manual. Much of the content hasn't been authored properly yet, so it's still, a lot of it's just a placeholder. But for now, let's look up credit ratings. And you can see it's sort of meant to be in the style of Encarta from the era, but it needs to, it's still not polished. Okay, so we have credit rating here. We have a list of the different types of ratings. So AAA is the best, all the way down to D, which is in default. So the first one we rejected was CCC minus, so substantial risk, and the one we just accepted was BBB. Intentionally, we're not going to tell you what loan to make and what not to. We're not going to let you know the probability of default, but it is also worth being aware that it's not as straightforward as just saying the rating, because the rating defines the probability per unit time that the customer defaults. So every second there's a probability they default. So default, to be clear, means they're not going to pay back the loan. A probability every second that they default on the loan, and the probability is defined by this. But what that means is if you make a longer term loan, you need to have a higher quality customer, a customer of a higher credit rating, if you want to ensure you get your money back. And that can be mitigated to a certain extent by having daily repayments where you get some of the money back at least, but that's the idea. So the idea is, as a player, you should sort of play the game and get a feel for what sort of loans make you money and which ones don't, but you're never going to be told directly. We see that one made us money because our equity went up. So we went from 50,000 to 50,451. So we've got another one here, BB plus. We'll approve it, and we see it's gone up again. So again, a good loan to make. This value is calculated based on the exact probability. It doesn't mean you can't lose money because it's all probabilistic. So the person we just lent to could default immediately. But on average, this is the expectation value. So again, we're going to approve this one. So we're starting to lend out more and more money. You'll notice here with the deposit account as well, we're starting to receive money in the deposit account. So we have inconsistent decimal points, so I will fix that. But at the moment, we have received $505 in deposit accounts transactions, and you can see it sort of fluctuates up and down as people withdraw their money. There's no approval process for that. That just happens in the background. And then for personal loans, we've lent out $12,821. We've lent out $12,000, but the value of it to us is higher because we're receiving interest on it. Okay, so that's good. We just need to continue that, and we need to make sure we have the balance here right, because if we have our personal loan rate too low, then it means we're going to lend money quicker than we can receive it. So that's something just to keep an eye on. So we're going to run it forwards a little bit more. Let's get another couple of loans out. BB, we'll go with accept that one. And again, we see we're starting to make some money. And let's go through and just have one more. Okay, so we got to the end of the day. So here's our end of day summary. Haven't talked about this yet, but this just gives you a sort of idea of some of the things that you've been up to. 4 new customers. We're compliant in terms of regulation. We'll talk about that. And then we've earned a qualification because I cheated to do so. Okay, let's get one more loan, and you'll see this line here is a daily line. Okay, so we have our longer term graph at the bottom, which we can set based on days, weeks, months, and so on. We haven't had much time pass, so there's not much to say, but and we've but anyway, so we've got this another decision to make. Let's approve this one. So there we go. We've made another loan. So overall, we've lent out 22,000, and we have received 3,500. So that sort of brings up the purpose of this video, liquidity, right? So you don't want to be in a position where you don't have enough money left to repay all of the people who have deposited money with you. So in this case, it's fine. We have quite a lot of cash on hand. We see we have $34,000 in cash, and people have only deposited 3,000 with us. So in that case, we know we're fine. They could all borrow all their money, or all withdraw all their money at once, and that would not be a problem. But that may not be the case, right? So let's continue to run time forwards and just approve a load of loans, and until we get ourselves into a position where that's is more of a problem. So as we make loans, you'll notice our cash is going down. So that just means we have less on hand to lend out to people. I'm not going to look at the credit rating for these for now. I'm just going to run through and try and lend out as much money as possible. And we're still receiving more in deposits. So let's actually come back and let's increase this deposit account slightly. This isn't how you would play the game, but we want to receive more and more money from our customers. So let's put it up to 11%, and we should start to get a bit more money. So where are we now? We have $30,000 in cash, and we have $12,000 we have lent out. So once we get to this point where we're going to start to get to the point where we have less cash on hand than we have to lend out, and that's fine. That's how a bank operates, but we just need to be within certain limits if that's the case. And to do that, we're going to go to the risk management window. So that's this exclamation mark in the shield. There's a lot of different ways you can manage risk in this game. This is due to market risk when you start trading stocks. There's Greeks, which is to do with options and so on, but we're going to talk about regulatory requirements. So the one that we're interested in at the moment is the reserve ratio. So that's this thing down here. So that's telling you essentially how much cash you have on hand as a percentage of what's been lent out. So we are over 100% because we have, how much cash have we got? We've got $27,000, and even in the worst case scenario that everyone came through the door tomorrow and wanted to borrow it, we have about 200,000, so 200% of what we need. So let's keep going, and you'll see that's dropping, right? And the reason that's dropping is because more and more people are depositing money with us, and as we lend money as well. I think that may have been a bad loan. Should we have a look at the equity window to see what happened there? Maybe not. Anyway, yeah, we keep going as we were going before. You can see where what's going to happen. Eventually, we're going to reach the point where we have less money on hand than people have deposited with us, which is fine. So here we are. We're at 77% now. So let's look into the details of our finances. We have had $22,000 deposited with us, but we only have $17,000 in cash. And as I say, that's okay, that's fine. But we need to just be careful, because once it gets to a certain level, you end up with problems. So if we keep doing it, we're going to get down to 10% relatively soon. And I'll cut to that point just to show you what happens. Okay, so here we go. We've got to the point now where we're below 10%. Nigel pops up right at the front. So Nigel's our advisor. We're going to talk about him more in future videos. But he's telling us we've gone down to 8.4%. This can be a problem. So it's a problem for a few different reasons. Firstly, your reputation starts to get a hit. And the problem there is that if your reputation starts to get a hit, people are more likely to withdraw money from the bank. And then you can end up in a death spiral where people are withdrawing money, your reserve ratio is falling, and you essentially end up in a liquidity crisis where, even though you're a healthy bank, right, from a sort of a financial point of view, you have the value of your bank is positive, you're in a liquidity crisis, meaning you don't have liquid assets on hand to be able to cover the requests of your customers, because you can't just call in the loans from everyone. That's not part of the terms of them. So now you're in a sort of a difficult position. So the solution would be, well, A, don't get yourself into that position in the first place, or B, try now to get yourself to a position where the people want to borrow less from you. So you could either, for example, go to your personal loan and just deactivate it, so you're no longer lending it, or you can make it on much more favorable terms. That's up to you. But basically what you need to do, you need to get your cash situation better. So what happens is, eventually the central bank will give you some money, and that is something we'll talk about in a bit more detail on another day. But essentially there's a central bank facility which allows you to, as a lender of last resort, if you get yourself into a liquidity crisis. But yeah, that's basically liquidity and how it can affect you. It's sort of one of the main game mechanisms to keep on top of, in addition to everything else. Okay, I think I'll leave it there, as we've gone on for quite a long time. And yeah, we'll catch up in another one.